Good morning, good afternoon, good evening to all of you around the world. Welcome today to our webinar brought to you by IMA, the Boston chapter, as well as the Performance Management Special Interest Group. Today's topic, I think, is very relevant and surely very interesting. It's finance transformation, why it should pay for itself in months and usually doesn't. Our presentation today it will be brought to you by Dean Sorensen. But before I go into the detail, let me go forward and just mention to you, for those who may perhaps do not know, just some words on the Performance Management SIG. The Performance Management SIG is a special a grouping of professionals who are interested in performance management. It provides thought leadership, a forum for exchange and best practices on performance management, so you can act as an expert to help improve the performance of your organization. You can find the Performance Management SIG, all information inside the IMA page. If you want to sign up today, you can see that there's a direct link. You can find it on the presentation, which is distributed. You can actually already have the presentation right now. There's a PDF loaded inside the On24 platform. And as you can see here, there's a link to sign up for it. And just quickly, some housekeeping rules before we dive in with Dean. You are muted upon entry. We have too many people to be able to have a live conversation. Please use the Q&A to ask questions and the attendee chat to interact. There will be a Q&A session held at the end of the presentation, but it will obviously be a Q&A via the chat. As we go through the presentation, there will be poll questions, and please answer the poll questions so you can get your CPE credits. As I mentioned, a copy of the presentation is available for download under related content. In order to get the full CPE, please attend the entire presentation and answer all the polling questions. Ideally, you're also completing the evaluation form, which is at the end at the very end of the presentation. And finally, the link to the recording will be emailed to the attendees along with a link to download your CPE certificate approximately 1 hour after the webcast. And now, just a few words to our presenter today. We have Dean Sorensen, who is a CPA, CPIM. He's the founder of the IBP Collaborative, and he has a rich background in accounting and in supply chain finance. And so with that, I'm going to move forward to another slide, and I think best to hand it over to Dean so he can tell us a little bit more about himself and his background. Thank you, Dean.
Thanks, Deborah. Yeah, one of the things about myself and that you're probably a little bit unique is that I have a lot of experience in the manufacturing sector from both financial and operational perspectives from both an accounting and a consulting perspective as well. And I've spent a lot of time in the past couple decades in the area of integrated planning, integrated performance management, and have really seen it evolve over the last couple of decades. And I think that there's a lot of different perspectives about what that really entails. And I've spoken about integration from planning and performance management perspective in a couple of webinars that I did last year. You can see them on the screen here, along with a couple of key things that I spoke about. And I'm going to be referring to these during the course of the webinar because, I'm not going to dive into a lot of detail and repeat things, but I'll just make mention of it when we get there. And because of these webinars and where we a lot of the things that we were talking about with regards to integration, we actually decided to kind of formalize I guess, an integration subgroup, if you will, specifically focused on manufacturers. And I think they were also looking at ones related to other industries. But what you find is a group that has started this has some really interesting perspectives in terms of where we think planning and performance management is going to evolve in the manufacturing sector, and very eager to kind of promote different ideas and how things are evolving. So this group, I think, is really providing some insights about things that are really missing in the marketplace and things that really aren't being talked about a lot. And this is kind of leading us to the focus of today. So like the key message is that integrated planning is a key driver of profit optimization, cost and profit optimization, as well as finance transformation. And it actually drives a lot of value, a lot of which can be realized in the short term to self-fund transformation efforts. But at the same time, deliver fast and more cost-effective processes in a shorter time to value relative to traditional things that we've been talking about over the last 10 or 20 years or so. And as part of this, you can see the learning objectives here on the screen you've probably already seen. But one of the main things I wanted to talk about is that I think there's a lot of confusion in the market as to what constitutes integrated planning. I mean, you ask 10 different people, there's 10 different definitions. So I think there's a real need to have some shared perspectives about what it really is and how it actually drives value, especially, how many people are involved with, ESG type things, or in the case of what I call integrated thinking and reporting, which is really being fairly significant in Europe. But I'm gonna come back to this when we get into it. But I think what we're talking about here today is highly relevant to integrated thinking and reporting. So like I said, I'll get to it when we get there. But as we go through, one of the things that I'm going to do, I'm going to touch on each of these different learning objectives. You can see them here in the agenda. And as I go through them, the intent is to kind of provide a picture of what are the key issues relating to integrated planning, what is the group actually doing, because it's just too broad a subject to kind of get into detail on everything. So I'm going to be kind of skimming over and kind of laying the foundation. And the intent will be that, as we start having more webinars and more roundtables, that this provides sort of a framework for how we think about it. So the first thing that we're going to start off with is current state and perspectives, and I'm going to provide a quick overview of some perspectives to kind of anchor what we're going to be talking about when we get into the learning objectives. So the first thing I want to talk about is just what people's experiences are with, financial and operational planning and performance management methods. So many of you have already implemented or tried, FP&A tools or XP&A tools. You may have a rolling forecast. I think a lot of companies who've done that in finance have also implemented sales and operations planning, integrated business planning, and it's not just that, business intelligence, a whole raft of things. But in the end of the day, when I speak to executives who've done a lot of this stuff, one of the things you end up finding is that they tend to be what I call hitting a wall, or they get to a point where certain things are still problematic for them. So despite having invested all this money in all these different tools and processes, what I consistently hear is that they still can't forecast and optimize costs and profits. They still can't forecast direct cash flow. Um, Forecast accuracy is an issue, as is scenario planning and decision support. So it can be a little frustrating for them that they're still having these issues. And especially when it comes to forecasting direct cash flows and working capital, I think that more forward-thinking CFOs, especially ones who have a lot more operational experience, one of the things they're coming to conclusions that it becomes increasingly difficult to do this unless you've got some manufacturing specific logic like bills of materials and routings, is that it's very hard to try to do direct cash flow forecasting without it. And if your intent is to optimize value, it's very hard to optimize value without understanding cash. And I think that in the end, cash is really becoming really sort of a leading indicator of how well your planning systems are working and how well they're supporting the strategic part of finance transformation. And I found this research study that Gartner published very recently about the 2026 CFO agenda. You can see here I've highlighted some things, and what I've shown here are things that are kind of key issues from a CFO's perspective that the ability to address these things really depends on your ability to integrate finance and operations, especially as you get larger and more complex. And you can see that here's the exact details of what was in the research study. And there's some other ones here relating to the efficiency of financial processes and financial and operational data. But the main point here is that the things that are most relevant to CFOs these days are relating to better integration. As well, the one at the very top, the cost optimization, Gartner found it to be kind of the top issue, but it's not just Gartner. If you look on here, there's 9 different other research studies, all of which rated it as the top objective that companies are struggling with. So what this is telling us is that despite all these things that companies have invested in, this is still a problem, and it's not being addressed by the current tools and processes that we're using. And if you kind of step back and look at how kind of the financial and operational tools have evolved, what we're finding is that I think that things are kind of starting to fall between the cracks, which is really emblematic or just denoted by things that you see on the left and right, the siloed between finance and operations. So when a lot of these tools first came out many years ago, the computing horsepower was different than it was today. And if you can imagine how things have evolved, having separate financial and operational systems made sense at the time because, technology couldn't support a more integrated approach. But fast forward to today with, computing horsepower the way it is, I think that what we're finding is that the separate financial and operational systems and processes really aren't living up to expectations, especially when it comes to cost and profitability management. And the ones who are really feeling this the most are the companies that are most complex. And, there's kind of some capability gaps are kind of falling between the cracks. So where these capability gaps really lie are in like direct manufacturing and supply chain costs, especially in financial solutions that don't have bills and routings. But kind of the one that kind of spans both is the overhead costs. We've really done little to materially improve the ability to plan and manage overhead costs, which is why we still have things like activity-based costing, and why activity-based costing is still exposing unprofitable products and customers, and it's still showing that profit and overhead cost planning models are actually still wrong, which is one of the things that we typically find from that. Gartner really kind of confirmed this one of the things that they highlighted in their CFO conference a few years was that companies were having difficulty managing cross-functional trade-off decisions. And what this really means is that, one of the things is that, while we can support basic tactical decisions, we're not supporting the ones having the greatest impact on value. Like a common ones might be things like, new products, new customers. Like the question is like, how do those things affect free cash flow? And the problem is that we're finding that we're not able to answer those questions. So what results from that is what some call complexity costs, which is really the cumulative impact of wrong decisions or suboptimal decisions and their impact on the performance of a company. And that these complexity costs really are becoming a permanent part of cost structures, and one of the primary reasons why we're not able to sustain cost reductions is that we don't have the processes to sustain them. So like I said, these complexity costs become embedded into cost structures. So what the graphic I'm showing here, the 3 to 5% of sales, is really being, like I say, firmly embedded into cost structures. And this is the same, these costs, if you will, unrealized costs, is the same unrealized value that companies are not getting out of IVP. So I'm going to come back to, these challenges that we initially started with and just ask a question from a polling perspective, like just to try to get a sense of where the audience is, which is, and I've separated this between simple and complex companies, and I'll leave it up to you to define how complex you are, but want to get a sense for, are these things that apply to you, or are they not something that apply to you? So we want to get a sense of, are these types of things that are of interest to you folks? So here's the polling question. So Deborah, we'll let you kind of run with this.
Right. Thank you, Dean. Everything is great. So if the participants can take a stab at answering this question. And as we wait, we'll give it a minute. As we wait, I wanted to mention that one participant, Trey, commented that this is really great to you, Dean, and was asking if a copy of the recording will be sent after, and he wants to share this with his team. And Trey, the answer is yes, the recording will be available after. So we're just going to give it a few more seconds. We have 84%, 86 have answered. Yes, I think how you explained this, Dean, I think this applies, I think, to many organizations.
You want to move on now?
Yeah, so all right, so now I see we have 92% have answered. I think we can move on. So let's move to the next, and we see the breakdown. Go ahead, Dean, I hand it over to you.
Yeah, it's what I would have expected. So for a lot of companies that are complex, these things really mostly apply to a lot of mostly applies. So, it really depends on the company in terms of where they at, but I think the vast majority of companies are kind of running into this. And for simple companies, obviously, they have a different set of challenges, which is really why I separated the two. And those are some of the results that I would have expected. So with that, then let's move on to the next section, which are, what are the kind of the key capabilities that really comprise an integrated system. So one of the things about, from an integrated planning perspective, it's really one continuous financial and operational planning process. And you can see the things there, the steps there, pretty basic things. And one of the things that you're really trying to do when you have an integrated process is to quickly and effectively respond to change. So answer what's changed, how does it impact what we want to do, and what's the change response? Just some pretty basic things. And what underlies the ability to do all that is the ability to have one executable plan. And what I mean by that is the ability to simultaneously translate demand into non-manufacturing resources, which are overhead costs, inventory resources, and and profitability and direct cash flow. So what I'm essentially saying there is really having one plan for the business that covers all resources. But if you look at the financial and operational solutions out there, these massive gaps that are sitting in between financial and operational solutions. And the biggest one lies in, as we talked about before, is in non-manufacturing resources. Like we've seen very little innovation in that area, and which really means is one of the reasons why companies can't optimize net profits, because they can't really focus on strategic trade-offs, because they can't forecast product and customer profits and direct cash flow. And that's one of the primary reasons why most companies really have not seen, significant movement in terms of their ability to do scenario planning. So if you look at, what companies are really talking about in terms of their, these scenario planning capabilities, those may be true for small companies, but I'm going to try to say this as politely as I can, that, I'd say that a lot of these discussions about, scenario planning, I think they're really positioning products in the best light, because I just don't see it happening. So especially things like the tariffs, that as we've seen a lot of discussion about that over the last few months. I'd say that most companies, when you think about how they're trying to respond to tariffs, are doing so on the back of spreadsheets. Maybe some systems help, but for the most part, they really don't have one overall system where they can address that. And I think it's a real problem for a lot of companies. And one of the issues with the inability to develop an executable plan is that, when companies with the current systems with FP&A tools and S&OP tools, one of the things you end up finding is once you forecast revenue and demand, it can take, I've heard people say, anywhere between 2 to 3 weeks just to get to the point where I've taken that demand plan, put it into an IBP, solution development operational plan, then from that develop a financial plan and forecast that can form the basis for scenario planning. And you really don't have a lot of time to do effective scenario planning. And what it should look like is something like this. From a planning perspective, the capabilities now exist where you should be able to take a demand plan, throw it into a model, and have it spit out a base executable plan that you can spend most of your time during a monthly planning cycle doing scenario planning, decision making, cost structure management, risk management. That's just not the case. I think that most companies are kind of feeling that. So going back to some of the previous webinars, I actually had a case where I talked about, executable plans and why it's important, and some key integration capabilities that you can go back and look at. And with this, one of the things I'd like to ask companies is that, do you have the capability to develop what I call a base executable plan that can form the basis for doing kind of scenario planning within a day or so of finishing your revenue and demand forecast? So we're asking just a simple question, like from a manufacturing perspective, yes or no, and a non-manufacturing perspective, yes or no. So let's just open it up and see what people say.
Yes, so please go ahead and give us your feedback, or choose which of these answers applies to your company. Again, can your organization develop a base executable plan within a day of forecasting revenue and demand? So we have 70% have answered. We're at 80% right now. Give it a few more, a couple more seconds here. All right. And let us discover the answers.
Yeah, so I think we're finding a real mix here. So I didn't just, in this one, I didn't distinguish between complex and non-complex. It was more of a, industry focus, but I suspect as you get into more complex ones, that's going to be more problematic. For smaller manufacturers, probably less so. So very interesting results. I think obviously some people are doing some good things. So let's carry on. So I think that we'll use this as a springboard to talk about some of the key changes that organizations need in terms of driving finance transformation and profitable growth. So the first thing I just want to talk about is the ability to drive what I call dynamic cost, profit, and value optimization, because this is really, when you think about it, a really good and market responsive process. Your cost structure should really just self-adjust to change. You really shouldn't have to be doing kind of special cost reduction studies. It should just really kind of fall out of the process. And this is really where I think that organizations need to get to, and what analytics should be giving to companies. And I've identified kind of 6 things which are kind of falling between the cracks again between finance and operations. So I'm going to summarize at the end these 6 things, but I'm going to start off and just kind of cover up what they are. So the first thing is, if you look at how a lot of companies are planning that and managing during the forecasting process, what we're typically forecasting are kind of gross margins, and that really, how you define that really varies. But what most are not doing is forecasting profitability. And what I mean by that, just really trying to understand how resources are being consumed by products, customers, and segments during the planning process. And it's a really difficult thing to do. And one of the implications of this is that it's really difficult to get establish effective ownership of profitability if you can't plan profitability. And actually, I found an interesting research study by Grant Thornton that actually summarized who actually owns profitability within the organization. And what you're finding is that it's not usually kind of like a segment owner or something like that. It's usually the CEO or the CFO who actually owns profitability. And if you look at, kind of one of the foundational things for really driving effective cost and profitability management, this is the one thing that'll probably do more things than anything else to drive profitability, just by having somebody owning it. So that's the first thing. The second thing is to use these executable plans or an integrated model that we've been talking about to engineer cost structures. So if you can utilize like a central model, you should be able to avoid a lot of the problems that many companies find, like too many products, over-engineered products, wrong pricing. If you've ever been involved with an activity-based costing project, these are some of the typical things that actually come out of the results of activity-based costing, especially when it comes to too many products or over-engineered ones. And most of these things really come back to the fact that most companies still can't quantify how new products, customers, and suppliers impact cash flows and profits. So that's kind of one thing. Another thing that you can do to improve profits just by engineering your cost structures. The third thing is that once you have those cost structures defined, how do you identify and expose what's changed? So, for example, your cost to serve costs may be different than what you expected. So in this particular case, I'm showing that we identify maybe there's a $3 million profit improvement opportunity. And this relates to, let's say we have one customer that we're forecasting $1 million profit, and we can improve that to 4 million by changing the average cost per order, which in one case is 2,000 versus 200, because of the order mix that we have. And that order mix is relevant because expedited orders are far more costly than regular orders. So if you have some company that, initially you think that they're not going to be expediting orders all that much, and they continually expedite orders, what you end up finding is that, they're not as profitable as you would have expected. And again, these are the sorts of things that fall out of activity-based costing studies. And that sort of insight is the type of thing that you want to have when you're trying to do effective cost management. So changes in the mix of products and or the service levels that you're providing to companies is a huge and untapped source of value in a lot of companies. So that's the second thing. So along with that, one of the things, if you really want to drive that sort of those sorts of cost reductions, what you want to be doing is focusing people on productivity as opposed to kind of fixed costs. And this relates directly to the ability to do dynamic target setting and resource allocation, because what you don't want to have is having people accountable for, fixed functional budgets that don't really change. That's just sort of a recipe for disaster. And this is one of the reasons why, rolling forecasts have not always been as successful as what you would like. So the key point here is what you want to have is a process that translates demand volume into activity volume and activity mix, which in turn drives, a flexible budget or flexible forecast where people are focused on productivity, especially cross-functional productivity. And that's a thing that's been missing, I think, in a lot of organizations in terms of really being able to drive profitability improvement. So just kind of going back to what I was saying, that these are the sorts of changes that organizations need to be looking to make in order to drive, meaningful improvements in terms of cost and profitability improvement. And again, these are the sorts of things that are kind of falling between the cracks with companies. So again, I touched on these things in other webinars. I can refer you to them. The executable plan case study, the key integration capabilities were specifically highlighted, but you can kind of go back to that and refer to it. So with that, the next question is, okay, this sounds all nice and well and good. How do I do this? So what's out there that's allowing me to do this? Because I certainly can't do it with what I have now. So let's just talk about that. So the first thing I want to make a point of saying is that, as somebody, I used to work for a prescriptive analytics software company. And, I also have a deep understanding of FP&A tools. I think I've actually done research studies I've looked at least 50 different FP&A tools over the years. And one thing I think that most FP&A or finance people don't really appreciate is how sophisticated supply chain planning tools are and prescriptive analytics tools. And it's like, if you look at the capabilities of FP&A tools and even newer FP&A tools, if you compare the modeling capabilities, it's like comparing a 64 Volkswagen to a brand new Ferrari. I mean, there's just absolutely no comparison. So this one slide here. So I used to work for a prescriptive analytics company. It's no longer in existence, and so I'm not promoting it. But one of the things I did want to mention to you that, when we were doing this work, and this was like 10, 15 years ago, the least amount what we saved a company was like $100 million. And we actually had 2 case studies where we saved companies over $1 billion. Just, the insights that one has with like a forward-looking resource-based planning tool are infinitely greater than ones that you're going to find with kind of traditional financial tools. Now, one of the problems with the tool that I mentioned to you that I used to work for, it had the model maturity and accuracy was just incredible. One of the biggest downfalls it had was that it was a beast to maintain this model. It wasn't really reconciled with finance all that well, and it really didn't really have effective cross-functional performance management built in to sustain it into our management process. But what's changed now is that, what I'm seeing now are tools that actually fix this problem. And the implication here is I think some of the best financial planning innovations are not coming out of FP&A tools, they're coming out of supply chain planning tools. But they're not just supply chain planning. I see the evolution into more what I think of as an enterprise-wide planning tool that connects business, demand and business volume to business process activity through to activity-based customer product profits and cash flow, which is then connected to resources and cash. So in other words, it's helping you to connect all this with financial and operational outcomes. Now, if you look at kind of traditional FP&A or supply chain planning tools, one of the things when you look at, from a direct manufacturing perspective, fantastic tools, some bills and routings, and maybe even some modeling capabilities a little beyond that. But for the rest of the organization, even if you look at some of these S&OP tools and IBP tools, the modeling capabilities and when it comes to overhead costs are just grossly, wrong, I guess is a good word. I mean, they're just totally outdated. And, in some cases, they either don't exist or the models that they're using are just completely wrong. And they're using kind of the same assumptions that we, people who've done activity-based costing have said that are just an incorrect way of doing modeling. What's new, I think, are tools that are now allowing you to model this with the same level of granularity as you would have in direct manufacturing. And I think this is a huge innovation that's really going quite unnoticed in the marketplace. So just from a practical perspective, what this means is that when I look at, like I've done kind of supply chain planning, activity-based planning, cash flow forecasting, tax optimization work, especially and around staffing. What you're finding is that you have one model that does all this stuff. You shouldn't have separate models. And that to me is really where I think the market is going. So especially anybody, like I say, any finance guy who's been involved with manufacturing for a while knows that the chances of you getting a really good, direct cash flow forecast without having a supply chain model in the middle of it is kind of slim to none as you start getting bigger and more complex, especially if you're trying to, optimize across legal entities, because what you also miss is foreign currency exposure, and these FP&A tools simply aren't equipped to do that kind of stuff. And one of the outcomes of all this, one of the features of a lot of these supply chain planning tools is that you can actually use them on a standalone basis to do kind of, structure your supply chain. But, these newer tools, what you can also use them for is a standalone model to look at cost reduction opportunities or even look at strategic issues like how do I respond to tariffs. So just from a perspective of how you actually approach things, you can actually develop a model first, get the insights, and then embed it in a process later. And that's the foundation for what the self-funding approach that I talked about earlier, that you don't necessarily have to wait to have the process up and going before you start, because you can utilize these models to find the types of cost reduction opportunities I mentioned before. Now, again, in one of my previous webinars, I went into a little bit more detail about supply chain modeling and integrated planning and how they differ from supply chain planning or financial tools. And, you can look at that at your leisure. So the next thing I wanted to do is just talk about it is a maturity model and how this all fits within the framework of a mature planning solution. So I think that when we typically look at the market today, we have FP&A tool, finance and operational tools, and we have different integration terms. You can see them on the screen, but when you think about it, if you look at any of the major analyst reports, they usually have like a quadrant or something along those lines. You probably know who I'm talking about. But the thing is, they are looking at these tools from a functional perspective. They're not looking at it from an enterprise-wide perspective. In fact, there is no such thing, as far as I know, as an integrated tool or integrated framework for looking at it. And the reality is that if you look at, these tools just more on a holistic basis, what you're going to find is that they really don't support the level of integration you need. So because you need both planning and performance management. If you're trying to drive cost reduction or profitability improvement, what you need is a solution that's actually going to cut down silos and drive horizontal planning and resource allocation, which a lot of these tools are not. So when you start looking at this more from a holistic perspective, you find that if you compare the traditional tools to one that is in the third area, if you will, what the difference is that one planning model and process that allows you to do direct trade-offs, and that when you're at that level, you should never have to manually reconcile financial and operational plans. Variances ought to drop out, that kind of thing. And then once you get a level beyond that, now you have one executable plan that's focused on profits. It allows you to manage and analyze complex cross-functional trade-offs, which then in turn allows you to have a more morph into more of a dynamic process that optimizes profits and performance globally across legal entities. And so one of the things I was trying to do with this maturity model was to articulate one where you could actually understand how value was realized as you started moving up. Because one of the things I often find with maturity models is that it's difficult to articulate what's that level of maturity worth. And that's really what I was trying to get across here. So the main thing to take away from this maturity model is that the key difference here is that in terms of modeling is that the ability to develop a shared understanding about the economics of business and how outcomes consume resources. And this capability is universal, I think, to all industries. So, for example, I'm not a banking expert, but one of the people that's involved with the performance management SIG is in fact a banking expert, and he is going to be doing a webinar in the near future about how this sort of thing applies to the banking sector and how this would transform banking. So, I think some of the things that are coming out of manufacturing and this evolution from supply chain planning into more enterprise planning, I think is going to spill into other industries. And I mentioned that I would come back to this because I mentioned it earlier. If you're, especially in Europe, if you've ever heard of things like integrated thinking and reporting, I think that this framework about managing outcomes and the integration between finance and operations is right in line with what we're trying to do with integrated thinking and reporting, and that these process and solution evolutions are going to play a huge part in driving kind of integrated thinking and reporting. And that, again, going back to the challenges I mentioned before, that these, to address the challenges that Gartner's really identifying is that you need these sorts of capabilities as you get larger and more complex. And I'm going to come back to the point of this screen here, but if you look at, the complexity on the bottom, on the left-hand side with overall maturity, that what you're going to find is that as you start getting more complex, that the overall maturity of your solutions and processes are going to start to diminish. So, when you're smaller and less complex, you can pretty much, use manual workarounds to get around just about anything. But the more complex you get, it's difficult to do so. So I'm going to come back to this in about 5 minutes and tell you why I raised this. But one of the things I just wanted to get across is, if you, like me, I do a lot of reading, but if you look at a lot of these solutions that have come out in the last 5 years, there's just a sea of different names that, united, unified, orchestrated, a lot, especially as it relates to a lot of these XP&A solution providers. The reality is, I don't think that these solution providers are really heading towards the sort of integration I'm talking here. And when I hear people talking about XP&A as being the next evolution of planning, I just don't believe it. What I see happening is that, I see just more marketing buzzwords, and, it's not that these solutions aren't better. It's just that I just don't see how they drive value. And what you end up finding is that if you look at the models underneath these things, many of them are actually wrong. And so, it's nice that you may have AI and analytics, but if you've got wrong base models and overlay analytics on top of that, the chances of you optimizing cost and profit just aren't there. So my belief is that if you look at a lot of these tools, I think that eventually companies really need one process, one model to do scenario planning. And I think especially in big manufacturers that have got kind of FP&A tools and integrated planning tools, the reality is I think these FP&A and XP&A tools, not that they're bad things. I think you're always going to need like an FP&A tool to do consolidation and all that kind of stuff. But the ability of FP&A and XP&A tools to do complex scenario planning, complex resource allocation, I'm not quite sure that they're really offering a viable alternative in the future. I could say the same thing about S&OP tools. S&OP tools are kind of like tools that are, a simplified version of a supply chain planning tool. Like I know I've probably looked at a half a dozen S&OP tools, and I know for a fact that when you get into bigger organizations, the models inside those tools are just fundamentally wrong. They're just not driving. If your intent is to drive decisions based on value, they're not going to give you the right answer. In the short term, perhaps, like if you're trying to balance cost service trade-offs over the next month or two, perhaps, but if you're looking at something to look at over the long term, not so much. So when I think about what really kind of separates some tools from other, there's only a few questions I really need to think about. And that's, what's the solution worth? Where's the value? How long to self-funding? Because if a solution provider has really thought about these things, they'd be able to have a clear and concise answer about that. And they'd also be able to talk to you about how they manage cross-functional trade-off decisions. And if you pose these questions to especially FP&A vendors, you're going to get, a blank stare in many cases, because they're not designed to do this stuff. Again, not so much for small companies. Big companies, can be a little problematic. So let me quickly just talk about roadmaps, that kind of thing. This is a really like an overall slide that has a roadmap, and I'm not going to talk about each one of these things, but I'm just going to talk about a couple of things, for you to think about as you go away. But one of the things that I think about is really kind of doing assessment of where you're at, and really thinking about, like, what's the likelihood of finding exploitable value? What are the symptoms and what are the capability gaps? So, like, if you're a company that's got, we know that we have a product proliferation problem. We know that we have, a cost problem, and there may be a lot of flags on the field, if you will. Those are signs that you're probably going to end up finding opportunities for profit improvement. So one of the first places you should start, like just spend an hour, within an hour or two, you should be able to understand what's the likelihood of finding value, and move to a more detailed current state assessment later. But just with a high level assessment, one of the things you can do is then start engaging the executives and or a sponsor. For example, if you're dealing with a CFO, one of the questions you should be asking are, what processes and methods address kind of the capability gap. So how do we get better direct cash flow forecasting, and what's the value of doing that? And again, what's the likelihood of self-funding if we've got good opportunities there? And then based on that, you can utilize kind of a short-term approach to identify likely sources of model, develop a model, and develop action plans to realize the value. And then ultimately that should drive into whatever solution and process strategy you're trying to execute against. But when you start looking at a strategy, one of the things you ought to be doing is looking at how does it affect all these different factors. Like in a lot of companies, especially more complex one, you're probably not going to be able to achieve all these objectives simultaneously. Perhaps in a small and simple one, you'll be able to realize them. But one of the base things, like for companies who are looking at implementing or just first implementing either financial operational solutions, I think there's a huge opportunity to drastically reduce both the cost and minimize the complexity just by looking at new innovations. So I'm going to quickly get to the conclusions here because we're running out of a little time here. So the main point here, when we look at integrated planning, is that I think it's highly interconnected to all these different things I've talked about here. You can see on the screen that you really have to think through integration in terms of how you're going to address these. And of course, there's other things like with integrated business planning, which is a different subject altogether, digital transformation. All these things, all these issues are highly interconnected. And that, if you think about one capability that you really need, you need to have the ability to have an executable plan that can deliver against all these things, because, the foundational capability is the ability to manage resource consumption, plan financial and operational outcomes, and that's the thing that's really driving the self-funding part. So some of the key takeaways, just from where we started, that when you think about, how you're going to integrate, the thing that I would be looking at is like, what's it worth? Why is it self-funding? What capabilities do I need to have? And what are the potential actions to get started? And this performance management SIG, one of the reasons why we started this is that, I think there's the way that the market is looking at this is really obscuring, I think, capability gaps, innovations, and I think there's a need for like an objective and forward-looking group to kind of share perspectives and to provide, have a place to provide insights you're not getting elsewhere. And we have a first meeting in a couple of weeks I'm going to mention in a sec as we start formalizing this. So there's some folks that I'm that are online. Deborah's on the line here. There's kind of a small group of us who started this enterprise-wide planning for manufacturers. And the question we're really asking is what lies beyond IBP and FP&A towards truly integrated planning? And in a couple of weeks, you're going to hear Bill talk about some of his perspectives. And this is a guy that was a finance guy out of college, but became, his last position, he was a chief supply chain officer. You're going to hear some very interesting perspectives of Bill from both finance and operational perspectives. And you're also going to, one of the things we're also doing is starting a research study that Deborah's actually working on with Sridhar here. So Deborah, perhaps you can just say a quick thing about the research study.
Yeah, thank you, Dean. Just quickly to all of you, I think that all of you have received an email from me and from Sridhar with a questionnaire. And that questionnaire goes through some just general questions about your industry, the size of your company, and then asks you some questions about the application tools you're using, etc. And all of this is to get our finger on the pulse of the planning environment. And where do companies struggle? So I just want to say thank you very much for all of those who have already answered. And if you could just spend a few minutes going through this, I don't think it'll be very much. And then the results of those will be presented at the roundtable that's coming up.
Yeah, so here's the roundtable here. Like you can access this on the IMA site. So one of the things that we'd like to do is talk about, some of the results and, what people are finding, but also, and I don't want to be too prescriptive on this as well, because as a group, what we'd like to do is kind of respond to some of the challenges that you're dealing with. So we'd love to see you at the roundtable. That will be more of an open forum to, listen to some interesting perspectives as well as to kind of share ideas. So with that, I'd like to open up the next polling question. And as we do that, feel free to submit questions as well. But this is kind of like the next question, which is in your organization, do your functional leaders agree on the capability gaps that are holding you back from achieving optimized business performance? So and I've separated this between complex and simple organizations, and you can kind of figure out, which group that you belong with. And anyway, there you go.
Perfect. So we're just going to wait a little bit. And the time went by very, very quickly. This was a lot of very precious thoughts and angles to think about the whole cost and the planning aspect for supply chain. So right now we have about 60% of participants who have answered. And as we wait for participants to answer, as Dean just said, if you have any questions, please go ahead and write them in the attendee chat or in the Q&A. I think we'll have a few minutes to cover those.
Let's move it along.
We're at 70%.
Yeah. Well, if they haven't answered now, I'm just going to click
All right.
So. That's great. I think that, finding an interesting mix here. I think that for a lot of companies, I think when you get into complex situations, the capabilities that they need aren't always as clear. So I think that a lot on here do report that they have the right agreement. So that's good to know. So the next one is there a clear understanding of what fully integrated processes really are, the problems they address, and what they're worth? So I'd be interested to find out, given your last question, the answer to your last question, do we really agree on or really know what fully integrated processes are?
And Dean, while we wait for participants to answer, we have a question here from Gary Kokins. And Gary's asking, what is one major lesson learned implementing the methods you described?
I think one of the major ones, when you think about where the value is coming from and, how to really drive something that's strategically important, I think that the ability to actually manage resource consumption and have a model, I think we call it like a causal model that helps you understand the connection between, what your objectives are and resource consumption, I think is going to be, increasingly important as companies get larger and more complex. That's probably one of the major takeaways um, from the implementation of these integrated approaches.
All right. We have 41% who have answered so far.
So
Yeah.
we may not have a lot of time for a lot of other questions, but just to reiterate that I think that, we're going to have a roundtable in a couple of weeks, and that if you would like to attend that, we're going to have like an open mic, if you will, where you can ask questions and we can get into more detail on some of these issues.
Yes. Yes.
I'm just going to
And we'll
click
be posting
next.
the link of that to LinkedIn, to the SIG page. Yes.
So anyway, I think there's for the companies that are on here, I think there's a good mix of, or I think the majority have a good understanding of what integration really is, and the problems they address. So I think that's good. A lot of companies on here are kind of ahead of the curve on this. So with that, I'm just going to say thanks. If you want any information, you can, certainly reach out to me. There's my contact information, but I appreciate the time to talk to you people and present some of these perspectives, and hopefully that you'll be wanting to join us with this integrated planning group that we're developing, and would love to see you there.
All right. As we're over our hour, I also want to say thank you very much to you, Dean, and thank you to all attending. And yes, please sign up to attend the roundtable, which is coming up, and you'll be able to speak live to Dean and to the others who are there. With that, thank you very much. Goodbye.